Imagine you run a big company, right? And let's say I'm the CEO of a big company. I want to have a way, without ever having to use a human, and I can get this answer in less than 5 seconds. I want to be able to type in, what was the gross margin? Let's say I'm the CEO of Apple. I want to type in, what was the gross margin of Apple in 2009? And be able to see that immediately. I want to be able to type in, how many iPhones did we sell in the first quarter of 2014, and be able to see that within 2 or 3 seconds, right? How many customers have upgraded from an iPhone 13 to an iPhone 14 so far this year, right? I'm sure Apple has that data somewhere, but I can tell you that data is probably not going to be easy to get to. Imagine if there's a system that could spit that answer out like that, right? But also, if it's giving me real-time data, I can't have all my employees having that, right? It can only be a few select executives. So these are the important things that we got to think about as these systems get built out over the next 5-10 years, and that these are the type of things that Palantir's working on here. Think about how much faster you can make decisions if you don't need a bunch of people running around trying to find that, hey, how many iPhones did we sell in the first quarter? Oh, let me look that up. Okay, I'm got to start going through these files and all this data, right? But on the flip side, you need only certain individuals to be able to see certain segments of data, right? Like maybe you don't want everybody to see every single data point, right? Like let's say we're getting into some more confidential information, like what was our main chip supplier last quarter for XYZ chip that goes into the iPhone, and how much were we paying them, and what gross margin did that company actually report, right? Let's say I was trying to find out those sorts of data points in regards to a company. Certain executives might have access to that, but maybe certain other folks shouldn't have access to that are inside the organization. Imagine you're a government entity and you need to find out information and have the system sift through data and be able to spit you out an answer that's accurate and true within seconds, right? And so not only does that information need to be perfect and right and correct, but also certain people should have access to certain data and be able to use, let's say, something that's similar to a chat GPT, right, to give you this information, but other folks shouldn't have access to that, right? Never mind organizations outside of that organization, whether it's a government entity or private entity. And so this is the work that Palantir is putting in here that I think is very important to break it down in the most simple place possible. I don't know if you guys heard what Elon Musk said, but Elon Musk kind of, put it out there that we should do like a 6-month pause on AI technology and whatnot. And, it sounds like CARP's definitely pushing back here. Some have called for a pause on efforts to develop even more powerful versions of these emerging technologies, hoping perhaps that our adversaries will join us in consideration, in considered reflection on the capabilities of such systems and their accompanying risks. To pause our current efforts, however, would be to indulge in the fantasy of a world without conflict. Very well put, Alex Karp, right? I mean, it goes back to the theory of why do we need weapons? Why do we need tanks and missiles and all this stuff, right? And it is a great theory. Like, I wish we could get rid of it all throughout the world. There'd be no missiles and tanks and conflicts and things like that, right? But that's just not the reality. It's just not the reality, right? It's no different than it would be nice to not even have to have a car alarm, right? Like, why should it would be sweet if we all got rid of all our car alarms, right? If you did that, there's obviously a lot of people out there that would break into cars a whole lot more if we did something like that, right? And either steal the cars or go for joyrides or steal the stuff in them, whatever, right? And so that's why we have that, because there's a lot of people that choose to do that. And so it's nice to believe that, we could do this, do that, but the bottom line is not everybody agrees with that stance. And therefore, you must protect yourself and to, kind of stop what the work that's being done and hope everybody else stops. Yeah, I think that's it. It may be in a perfect world. All right, so markets in general, right? Very interesting day out there here today. A lot of green, but a couple big movers down, right? Microsoft and Amazon. In its own cloud worries, analysts talking about cloud worries from Microsoft's cloud, maybe potentially Amazon Web Services here over the next 6 to 12 months in regards to that, right? And I don't talk a lot about Microsoft stock on the channel. I don't own Microsoft stock, but I mean, this is a debated stock right now because a lot of people feel like it's expensive. I don't know if it's that expensive, to be honest. Forward P at 27 on the stock, right? Market trades at 20-ish, somewhere around there, maybe slightly under. So you're talking about you're paying a bit of a premium for this company, but you're buying a business model that is somewhat recession-proof. I mean, you think about Microsoft and whether the economy is great, okay, bad. I mean, they're going to continue to put up their numbers, right? And you even think about their cloud product. It's a needs-based product. It's not like you can just get rid of that. And you also look at something like Microsoft is now an owner of roughly 50% of ChatGPT, which is the biggest opportunity we've seen in a long time, right? I mean, there's a lot of thought that ChatGPT long-term could be the next Google. And if Microsoft owns almost half the company, and you could run the numbers on that, if they become the next Google, we'll see if that happens, right? But they have a long runway ahead of themselves, right? And that's an incredible opportunity for Microsoft. And so when you look at a stock like Microsoft, I don't know if it's really as expensive as people think, right? And if this stock went down, 10, 20%, I would actually probably consider buying a position for myself, which I've never actually owned Microsoft stock in my life. But I got to say, there's a lot more that is a very comforting feeling to be in a stock like Microsoft overall, right? Now, this is bad news, okay? Bad news. This is a commodity index. This baby's, let's call it what it is, skyrocketing recently, specifically over the past several weeks, okay? I mean, this is a year-to-date, and now on a year-to-date basis, commodities are actually up. This index is now actually up 1%. We don't want to see that, folks. We do not want to see that. I'm hoping this is just a short-term situation we have going on here, and then commodities are going to come back down, because I'm telling you, this is not good. This is not good for the market. We need to continue to kill inflation. If commodities spike massively for any reason over the next few months, it's going to make the Fed's job harder, and it makes the odds of the Fed having to raise rates more or keep rates higher for longer. It makes it a higher probability. And this is why if you look at something like Trueflation, which I love to look at for kind of real-time inflation data, in my opinion, right? You've seen a spike up here over the past few weeks. That's not something we want to see. No. Okay? We need to continue to see Trueflation numbers go down and down and down. And over time, I believe the U.S. government numbers will reflect where Trueflation's at. But, I mean, we don't want to get stuck in the 4s. That's all I'm going to say about that. We need to climb down to we need to see this number go down in the 3s and then stay in the 3s and then hopefully reach a 2. That's when we can really, really feel confident about the Fed being done in this game. But until that happens, you can't really say the Fed's done, right? When the Mexico Gigafactory gets online, which should be online likely next year at some point in time, I think they're likely going to use that. If they're going to talk about, exporting to another country, I think they'll use that out of Mexico. And obviously they're going to continue to use their facilities in North America as well in terms of the United States of America. But I think the Mexico Gigafactory margins will be significantly better than what they're producing out of Austin, what they will, are producing out of Fremont or anywhere else for that matter. And it's not because the workers are better in Mexico or worse in the United States or anything like that. It just comes down to math. It comes down to labor. It comes down to wages. And we do know in Mexico, you're going to be able to get labor at significant discounts compared to that same worker that's, say, at the Austin Gigafactory. Because if somebody's working at the Austin Gigafactory, they're going to want $20+ an hour, if not $30+ an hour. In Mexico, you're not paying, $30+ an hour. I can just tell you that, unless it's some sort of senior manager at the facilities or something like that. So ultimately, people are so caught up into Tesla's short-term margins, but the more I look at it, the more I'm bullish on Tesla's long-term margins. I'm not bullish on Tesla's 2023 margins, but I'm very bullish on Tesla's long-term margins. If suddenly, the Fed starts dropping rates here, and let's say the environment gets better for Tesla when it comes to getting loans, right? I can tell you, Tesla's likely going to start raising price on those vehicles again, okay? So don't just assume like whatever price they're getting now is the price forever. We've seen Tesla move around pricing. From what we heard on the conference call, what the CFO said on the conference call, they asked him, how often do you guys look at pricing and adjusting pricing? The CFO said, they're looking every week, okay? They're looking every week on if they should adjust pricing up, down, all around. And so this is something to think about in regards to Tesla is like, and you don't hear this talked about as much when they're actually raising pricing. It's a lot more when they're actually lowering pricing, okay? And so just that's all I'm going to say about that situation. They could definitely raise price in the future. Now, if we look at some Tesla numbers here, okay, this is interesting. So these are future projections for Tesla in terms of EPS and kind of what the PE is based upon these estimates in future years and whatnot, okay? Now, first off, I don't pay any mind to whatever analysts have for anything further than basically about a year out. And the reason being is analysts have enough trouble getting numbers roughly in line over the next 1 to 2 years, never mind, 3 years out, 4 years out. And also, look at how ridiculous these numbers are, right? Oh, so supposedly Tesla's only going to grow 9% in 2028. But supposedly they're going to grow 71% in 2023. But look, there's only one analyst that puts up those numbers, only 4 analysts, right? So it's these numbers, it's like, okay, interesting, I guess, but it's just complete waste because I'm telling you, none of these numbers are going to be even remotely close to accurate, okay? So what I like to look at is what they have for 2023 numbers and what they have for 2024 numbers, right? So, if you look at valuation-wise and you're wondering, is Tesla stock overvalued or undervalued, those sorts of things, right? You're looking at a stock right now that's at a forward P of 47 based upon what analysts have them doing this year for EPS numbers, right? Let's just assume Tesla and GM, right? Let's assume both those companies' numbers are accurate, which I don't agree with this, I don't agree with this, but let's just say it, okay? Let's just use these two as an example. So 44% growth expected in earnings per share next year, right? General Motors expect to have 2%, which once again, I don't think that's even going to happen. But let's say that does. So let's do a little math on that. Then means Tesla's going to outgrow GM over 20x in earnings per share next year. Over 20x. So if that's the situation, then Tesla should be commanding a forward PE next year of 100 plus, of a 100 plus. But where's Tesla at? Tesla's at a 32. That's not 100 plus, but that's what it should be. Because if Tesla's outstripping that sort of growth, they should be commanding that sort of valuation, folks, okay? And so at the end of the day, like when I look at Tesla, I see a company that's undervalued right now and undervalued by quite a bit. And this is a very different situation than a few years ago, because Tesla's played catch up in regards to their growth now versus where it was a few years ago when we were talking about $1 trillion market cap here, and the valuations come down substantially. So as Tesla stands here today, I'm looking at a Tesla that I believe is undervalued versus a market. Whereas everybody looks at this and they're like, oh, GM's at 5 forward PE, Tesla's at 32 PE based upon 2024 numbers, GM's at a 5 based upon 2024 numbers, right? I'm just telling you, like, you got to look at the growth. The growth matters in a substantial way. And ultimately, Tesla's undervalued. And if you want to say General Motors is overvalued, you could say that. I'm not going to say that. All I'm going to say is Tesla's significantly undervalued, folks. Significantly. And I think Tesla's in a prepping up mode to make its next massive move kind of up here. This is phenomenal, great news. Phenomenal, great news, okay? Inflation, as far as trueflation numbers, they have us under 4% right now for trueflation numbers, okay? Now, this matters in such a huge way, right? Because what has been the number one thing working against the market? It's been inflation, right? It's been the fact that prices have been going insane. The Fed's had to work against the market. It's been a nightmare. It's been a complete nightmare. And so the fact that you see trueflation numbers coming under a 4 number is huge. And like, the government numbers will go to wherever trueflation numbers are over time here, okay? And the interesting thing when you look at trueflation numbers, right, is remember, trueflation numbers could be, let's say, if they are somewhat inaccurate, they could be actually inaccurate to the upside, okay? And if you think about it like this, right, the government numbers never had us at these sorts of numbers. The government numbers had us max out at just over 9%, while trueflation had us at what it believed the real inflation number was at 11 or 12%. So when you see trueflation coming at 3.8, don't be surprised if the government numbers over the next few months come under whatever trueflation's at, because trueflation's already been to the upside. So this is something that's very important to factor in here, folks, okay? Very important. And a lot of people always believe that the government kind of cooks the numbers anyways, they say, right? That's always been the saying since I got in the market, right? And the government, puts out whatever they want to put it out and changes. And I'm not going to get into that whole debate, but there's a thought process around that. So if you're thinking about that, then you could be saying maybe the government numbers will come in at a 3.2, 3.3, 3.5, something like that, in a month or two, right? Because government numbers lag because they're always releasing like a month and a half after the numbers are actually out, okay? So this is very intriguing. And now this matters in a significant way for how stocks are valued here, okay? And here's why. So with everything that's going on with First Republic, And also, if we're talking about commodities continue to tank here, if we have more of this problem, right, then Jerome Powell is not going to be able to raise at the next meeting. Now, there's about, from what I've seen, around 80% of market participants are expecting the Fed to raise rates. That's as of this past week. The numbers could switch all around, okay? Around 80% were expecting the Fed to raise by just like 25 basis points and then be done, okay, at this next meeting. But here's the deal. I believe there was like a 50-50 that on them even raising on this next meeting. If not, like a 40-60, like they're more probable not to raise than raise, okay? But there was before this FRC situation got worse, as before more instability in the banking system. If you're talking about more instability in the banking system, that's going to put Jay Powell in a situation where it's like, it's not even worth raising right now, okay? So we know Wall Street is the kings of manipulation of whatever they want to manipulate for price, okay? So if they want Jay Powell not to raise anymore, and they say, you're done, mister, okay, then what they'll do is they'll continue to kind of tank and cause massive volatility in the banking space. There's nothing more important than causing instability in those stocks. Nvidia, Tesla, Meta, those stocks, they don't matter for the Fed making decisions. They don't care. Banking, whole different situation. Bank runs, bank stocks going down 40, 50% in a day, 10% in a day, 20% in a day. That's a whole different can of worms there. That's what the Fed looks at and says, oh boy, like we got real problems out here. We're creating real problems and we got to stop working against this market because there's massive instability in our financial system. And one of the Fed's jobs, right? The Fed has two main jobs. One is to keep prices in control. The other job is to keep unemployment low, right? The third kind of other job they have that is kind of not talked about as much is creating stability in the financial system. And if I'm telling you, if these stocks continue to tank and just be up and down and just insanity over this next, I would say 7 to 10 trading days, the Fed will be put in a situation where they won't raise. Because they'll say, and so it's up to Wall Street, really. We know Wall Street could easily manipulate these stocks. You think FRC is just down 40% by accident today? You think they didn't already know these numbers that they were going to report? Come on now, okay? There's certain things going on, and there's certain stocks moving certain ways because they want them to move that way, okay? The big Wall Street money, because they can shake those up however they want to shake those babies up, right? Fund managers are bearish on the market if they're choosing not to buy, right? Well, that means they're not really putting buying pressure out there in the market. So what happens as, over time, more and more of those fund managers flip to, let's call it, the bullish side, and more of them engage in the market and become buyers in the market? Well, it almost becomes a self-fulfilling prophecy of sending the market higher and higher and higher because there's more and more buying pressure out there. When almost all the fund managers are bearish at a particular time, that means they're not buying, right? Because if they were bullish on the market, they would be buying. So if they're all bearish, that means they're not buying. So all it takes is a few of them to come in and be a little more bullish, and it sends buying pressure in the market, right? And when you get that more and more buying pressure, it can send stocks up, the entire market up, more and more and more. Now, also check out this. I thought this was a few interesting points to bring out, right? If we look at this, summer 2007, basically sentiment was very, very positive. And what happened right after summer of 07? The market topped in summer of 07, and the next 2 to 2.5 years were awful in the market, right? The next 2 years were awful in the market. If we look at here, right, this was shortly before a fall 2018, which we had a bear market in the fall of 2018. It was nasty. I went through that market. It trashed me for a bit there. It was ugly, and for anybody that experienced that market, you know what I was speaking about, right? It was a nasty market. We got shredded, but look at sentiment right before that happened. Sentiment was amazing. Bullishness. And what did we get thrown in our face? An insane amount of selling pressure in the fall of 2018. It was ugly, okay? Check this out. I mean, this is about the most bullish we've ever seen the market in terms of sentiment. And what time period was that? That was early 2021, right? 2020. This is during the 2021 craze. We saw these numbers get about to the highest ever. And obviously, if we're thinking about recent times, it was probably one of the worst times to be a buyer of stocks in that early to mid 2021 time frame, right? So isn't this just a fascinating thing? And it almost goes to show you that you almost want to move against when these folks are so far on one side bullish or so far on one side bearish. You almost want to move completely contrarian to whatever side they're on. Because, I mean, when you just kind of look back at the data, you kind of start to find, oh my gosh, when these guys are all bullish, that's time to maybe sell or stop buying. And when all these guys are bearish, that's definitely, at least traditionally, it's been the time to buy. We'll see if it plays out again. It's played out so far. I can tell you that. Look at those numbers where we're at in October versus now. Absolutely fascinating, right? So, ELF stock, another new high here today, right? And this stock just continues to do well. I mean, some of you guys have taken advantage of some opportunities in the market the next the past 6 to 9 months. And some of you guys are going to have bought your ELF stock. I don't know what stock it is, okay? I don't know what stock you bought and have been buying, and hopefully you've been building out a great portfolio of 10, 15, 20 stocks. But you might have an ELF in your portfolio, like I do, right? And just remember, the story of ELF is a story of me seeing this company before other people saw this company and making profits and then taking my profits far too early. There was a time period when I owned nearly 10,000 shares. And so just make sure, whatever stocks you found that are your next ELF, don't be like me and take your profits way too soon and then be sitting on $1,000 and be like, or 1,000 shares and be like, why isn't this 10,000 shares right now? This should be close to $1 million position for me right now. But it's not, because I chose to take profits and profits and profits on a company that would just continue to execute better and better and better, and I shouldn't have done that, right? I want to share some perspective. Why has this been the most anticipated, expected recession, okay? It didn't have to be like this. It didn't have to be like this. It didn't have to be like this, okay? The bottom line is, the reason this has happened is because we chose not to call a recession, because the bottom line is in 2022, we had, if you go to any business school, they will teach you what a recession is. And the number one thing they teach you is 2 straight quarters of negative GDP, right? And so we had an actual recession in 2022. But since the unemployment rate was so low, under 4%, they made the decision to basically not call a recession. So instead of just facing the fact and saying, gosh, we got a recession here, then they said, okay, it's not a recession because unemployment's low. And it's like, you got to understand, there's different ways you can have recessions. It's like, just because everybody's got a job, if people don't feel great about their money situation, right? If everybody's having to spend a fortune just to buy groceries, you can have a recession that way as well, right? And if you got negative GDP in consecutive quarters, everything else was lined up there. Look at investor sentiment. Look at not just investor sentiment, consumer sentiment. The Michigan's consumer sentiment was the lowest we've ever seen in the history of that sentiment. That happened in 2022 when we had what was actually should have been called a recession, and they chose not to call it a recession. So because they chose not to call it that, now everybody's still waiting for a recession. If they just called it that, then when we got back to, let's say, positive GDP, then we could have said, oh, we're climbing out of the recession, we're on the climb back, right? No different than we, coming out of 2009, coming out of that recession. And as you started getting some quarters of positive growth, it was like, oh, we're coming out of the recession. So instead of having a narrative around we're coming out of the recession, they're still worried about we're going in the recession. You see that? It's a totally different change of mentality because we chose not to call something that it should have been. I released a video after the market closed on October 12th, 2022. And I said the stock market is set up for an epic rally. It was a 21-minute video, and I went into all these different points on why I believed the market was going to be set up for an epic rally. And obviously, we got the epic rally, right? But it was fascinating kind of reading back at the comments at that particular time. Because the comments were I would say a lot of them were very against what I believed in that situation and the data I laid out, okay? This person says, not yet. Got to see a leg down before the rally. Fed hasn't pivoted. More pain still coming. Jeremy probably went to Planet 13. Whatever he's smoking must be good, right? That was the approach. It was just like, that's how bearish everybody was, that they couldn't even take, me laying out all the data and saying why the market was set up for an epic rally. And sure enough, we got the epic rally. Obviously a lot of this type of stuff, just calling me a clown, just calling me names, stuff like that, right? And, to be honest, 2022 definitely changed my approach to YouTube forever. In kind of just my thoughts and process and everything when it comes to that, because I'll never forget the way I was treated in 2022. I will never forget that. And I'll never forget the way people treated me. And it was mostly from people under the age of 30. I'll just be honest. And so nowadays, I don't even make my videos with edits and all this fancy stuff, because at the end of the day, I'll never forget the way I was treated. Never. And I've always seen, especially with the older demographic that are more mature, have been around longer, experienced more markets, like they know there's some people that are under the age of 30 that are really mature and have, great thoughts and those sorts of things. But what I found is we attracted a lot of people in the stock market under the age of 30, not mature, just completely, those people that you just are just like, I don't even want to be associated with these sorts of folks, right? And that's who dove into the market in 2021. And then for any of us that had long positions in 2022 and got shredded, right, which I did and so didn't everybody that was basically long, we got treated like absolute crap. And, all those people even in the market nowadays, no, they're not in the market, they're long gone. But that's what happened, right? And so my approach always now is I create videos for more mature folks that are more experienced in the market. I'm not doing fancy edits. I'm not doing this. I'm not doing that because I don't want to even attract those younger demographics. If those people are mature enough to watch a 20, 30-minute video of me going through a million charts and a million data points, then great. But that's not who I make my videos for. What if the economy doesn't get hurt bad? What if we don't see unemployment go to 7, 8, 9, 10%, like all these experts are always predicting? What if we don't see that? Have we even considered that? What if unemployment stays in the 3s and 4s? What if inflation gets under control, as it's been starting to get under control, right? What if that continues for the next 6 to 12 months, right? What if the consumer gets in a much better place over the next 6 to 12 months than they've been over the past 6 to 12 months? These are all things you have to consider. You can't just laugh this off and be like, oh man, it's the end of the world. Why is the market doing this or something like that? It's absolutely ridiculous, but I see these Wall Streeters do it time and time again. And it's an easy thing to do when you've been bearish, you've missed this whole ride for the past 6 months, right? And you didn't take advantage of all the opportunities that the market presented us for 2022. And now you're hoping, wishing, laughing, and hoping this market goes back down, right? And it's just what we see playing out right now. Some would say there's a certain individual that is the boss of Jamie Dimon, okay? And no, it's not the board of directors of JP Morgan, even though that would technically be the boss of Jamie Dimon. Some would say the boss of Jamie Dimon is who? Jerome Powell. That's what some would say, okay? So let's say in this hypothetical scenario, that is his boss. Well, his boss wants people to preach against the economy, to scare people from spending, right? To not cause anybody to take any levels of major risk taking right now in the market, because any of that works against what the big boss, Jerome Powell, is doing out there, right? He's trying to prevent, if anything, the spending, which is why they keep raising interest rates, and they kept raising them, right? And so there's a moment when Jerome Powell is going to be fine with people going out there and spending money, and taking out loans and buying new cars and new homes and this and that. But that isn't right now, folks. That isn't right now. And so if you're on this conspiracy wave of Jerome Powell being the boss of Jamie Dimon, then you could be on the thought process of he's only doing what his boss wants, which is to scare everybody, to tell everybody, you need to tighten up. You need to be in a position right now of, security. Don't take risk right now. Don't spend money right now. Okay. The biggest thing that I think is the most overlooked in the market is the fact that many of the biggest companies in the world, and just many companies in general, have had the past, I would say 6 to 12 months, right, to really look at their businesses and start to right size these businesses. Whether that means cutting down on software costs, whether that means letting some employees go, whether that's reorganizing some departments, whether that's slowing down on hiring, everything like that, right? And they've really had a moment to really, because revenue growth is not very exciting right now. We're in it's called a slower economy, whatever you want to call it, right? And I think what's going to emerge is a lot more healthy companies. And you saw this actually in 08, 09. Companies emerged much more healthy coming out in 2010, 2011, 2012 than they were previous to the great financial crisis. And I believe the same phenomenon is happening now. I believe Amazon is going to be a much more healthy company over the next 2 or 3 years than they've been over the past 2 or 3 years. I believe Meta is going to be an extraordinarily more healthy company over the next 2 or 3 years than they were over the last 2 or 3 years. You don't always need your revenue to go crazy to have your net income increase in quite a dramatic way, which can increase your valuation, right? Many of the biggest companies in the world have done massive layoffs that are going through right now and started to go through in fourth quarter. And those layoffs are not just some, workers making $10 an hour or something like that. These are, workers making $100K, $200K, $300K, $400K a year, corporate workers, okay? And we're talking about billions of dollars of savings. We're not talking about millions of dollars of savings. We're talking about billions of dollars of savings. When you look at what Meta is going to be saving, Amazon's going to be saving, you go through a lot of these companies and you go through what their layoffs were and the cost benefit to that. It is astronomically high. And I just don't think there's enough, focus on that component. And that's just one of many reasons you're going to see EPS take off like a rocket ship for many of the biggest weights for the NASDAQ and even for the S&P 500 as this year kind of ticks on here. And what you're going to see from countless of these companies, and specifically the biggest ones, is they're actually going to report better and better earnings as the year goes on, with actually really strong back halves of the year in terms of earnings per share. We're talking bottom line. I'm not talking about revenue growth. I'm talking about bottom line EPS growth. And the reason being is so many of these companies have done huge cutbacks in their workforce that hit them in fourth quarter and is going to hit them obviously in the first quarter and a little bit in the second quarter. But now their business is going to be streamlined. Meta's profitability is going to go to the moon in the back half this year. Amazon's going to, okay? I mean, if I look at just like the whole host of the most important stocks out there, I see their profitability increasing quite dramatically in the back half of this year. It's going to happen with a lot of small caps too. A lot of these small cap stocks got absolutely wrecked last year by inflationary problems, shipping costs, everything like that, trucking costs, everything. They got absolutely wrecked. Commodity costs, and all these businesses are seeing, shipping costs has fallen off a cliff, trucking costs have fallen off a cliff, commodities have fallen off a cliff. And so what you're actually going to see is from a whole host of companies report far better profitability. So we're going to go through a very strange time where, the revenue growth might not be very strong or actually weak. But what you're going to see is EPS growth way outpace the top line growth here. So it's going to be a funny time to go through. And you'll start to see a little bit of that in the second quarter, but you're really going to see it in the numbers in the third quarter and the fourth quarter of this year. Why does this bull market feel so bad? Why is it so hated? Okay, I think there's a few reasons for that. One is constant just negativity from the media, from social media, from everywhere the past 6 to 9 months, right? About it has to go lower, even 6 to 12 months, we could say it has to go lower, just the end of the world, all that stuff, right? I think when that's the perspective that you're getting constant kind of fed out there, a lot of people just start to subscribe to that. I think the second component of that is because inflation hit a lot of folks last year, right? Specifically a lot of retail traders that maybe are in the middle class or whatnot, right? It's not the best feeling if, let's say, you're not in the best financial position to feel bullish on the market, right? Because if you feel negative, then you're going to feel like about your own financial situation, much more likely to feel negative about the market, right? Think about that for a moment. I think another component of this kind of hatred toward this bull market that we're kind of slowly getting into here is just the fact that investors look out there and they of the assumption that because certain markets fell certain percentages in the past, we had to fall that much in this market, which just isn't reality. No market finishes the same. And a lot of people thought, this is going to be an 08, 09. And they thought, okay, we're going to fall, 50% plus in the indexes, and it didn't happen, right? And so therefore, a lot of people just kind of they subscribe to this thought process. And so there's just so many various reasons on why this is a very hated kind of bull market we're getting into here. And you got to understand, many times when you're coming out of a bear market and moving into a bullish one, it's going to be very hated. I mean, I can tell you, the investors in the market were not bullish in 2009 for the most part, right? And yet we went into this massive, obviously, bull trend when the economy was still getting wrecked and continue to get wrecked for the next couple of years, right? And we continue to see housing weaken. And meanwhile, you saw stocks flying to the moon. And people were like, it's just that's the way it is sometimes. And, the same thing can happen to bear markets when people aren't ready for the bear market yet. And right now, people aren't ready for a bull market mentally. People this last 6 months move, I think for most investors, they just haven't been mentally on that wavelength to go bullish yet. And so they see the market going up and up and up, and many of these stocks doubling up, 70% moves, 100% moves, 150% moves. And they're like, and it's very uncomfortable feeling for, I think, a lot of folks out there. The conspiracy theory has been that this summer, at some point in time, we might see S&P 500 drop 10 to 20% in a quick amount of time. And it would be in such a quick amount of time that it would cause a lot of fear in the market, panic in the Fed. Wall Street would force the Fed to essentially start cutting rates. And it's been my conspiracy theory, whether it happens or not, we'll see. But that's just putting the pieces together, know how Wall Street loves to kind of play with the market, and really, I've felt like the Fed's decisions and everybody's decisions is really based upon what Wall Street wants, what Wall Street gets. And Wall Street doesn't mind that the Fed's been raising rates because we got to kill down inflation or it's going to cause a decade of problems. And so, but once we start getting to that place, if the Fed's not moving and they're not getting ready to cut, Wall Street will force them to cut. And they will force them to cut by dropping the S&P 500 10 to 20% in a quick amount of time. And that will cause fear, panic. You add some bad employment numbers on top of that or something, other bad economic numbers, and boom, the Fed's ready to start cutting rates. They'll have every reason to do so at that point in time. Market would be tanking, right? Oh my gosh. And then all of a sudden you'd see a recovery once they start cutting those rates there, okay? And all of a sudden the market would kind of balance out. So anyways, that's kind of a little conspiracy theory I have. We'll see what plays out there. Might not, but that's just always been something I've just been thinking about. Massive fear and scared folks, especially in the banking system. When that happens, gold goes through a boom cycle. Look back at the great financial crisis and look what gold did from about 2008 through about 2011 or so, right? Once the fear starts dissipating, right, and the banking system was then in the clear again, and you stopped really seeing a lot of bank failures in 2012 and moving in future years, you look what happened to gold after that, right? And look what happened to the stock market after that. And so just understand, in order to get gold to continue to spike higher and a lot higher, you really need people to continue to be fearful, scared. But one of the other limiting factors, in my opinion, on gold, and this is more over a longer term perspective, is a lot of folks that are in the younger generation do not look at gold as gold. If they're going to look at something as gold, it is Bitcoin. And I know there's a lot of maybe older folks that might be watching this video right now that you're like, that's ridiculous. Like, why these millennials, why they buy Bitcoin instead of gold? It's the way it is, okay? It's seen as digital gold. And so for a lot of people, especially in my generation, I'm 33 years old, right? A lot of people in my generation would much rather put their money, they feel like it's a safer place, it's going to give them a better ROI over the next 10, 20 years in Bitcoin than gold, okay? Take that for what it is, but it is what it is, okay? And so just do keep that in mind in regards to gold and excitement and if it's going to go higher or lower and things like that. Commodities, don't usually see them go down this much this early, but also keep in mind, we just came off the most insane bullish commodity cycle we maybe have ever seen, or certainly one of the most insane bullish cycles we ever saw. I mean, from basically through 2021 through the first half of 2022, certainly in my lifetime, we've never seen that insane of a bullish cycle in commodities, where almost every single commodity went to the moon, okay? It actually started in 2020 for a lot of commodities, specifically around summer of 2020. And so that's just one of those factors to look at, and you got to think, what did we come off of? Arguably the most insane bullish cycle we've ever seen in the history of commodities? Well, it makes that drop seem that much more significant. Like, it's like, basically what happened with commodities in terms of from the summer of 2020 through summer of 2022, right? That cycle was as insane, in my opinion, when it came to commodities as the tech bubble was to stock valuations. Let that sink in. It's interesting because I think everybody in the market, if you see the latest AIA investor sentiment numbers, right, we're neutral, as far as neutral ratings, actually overwhelming right now versus bullish and bearish. And it kind of, even if you look at like the public count, it kind of feels like it's in a neutral position, right? I mean, it kind of hasn't done anything in the last few months here. We're just kind of stuck in the 1.4 to 1.5 range. Let's call it somewhere in there, right? Entering this year, the public count was around 1 million. And then we just had this crazy up move. And now we're just kind of in stagnant mode because the market's really looking for direction. Are we ready to go bullish? Or is that just a little short-term thing? Are we ready to go bearish? Are we going to have some major recession? Is it not going to really happen? Is it, where we're going to get that soft landing or a mid landing, or are we getting, let's call it a hard crash landing? And so that's what the market's really trying to figure out. And I think that we're going to get some clarity in this earnings season. If we hear executives of companies be a little more confident, that's going to go a long way, because I can tell you last time they were not very confident at all in the last earnings season. A lot of cloudiness, a lot of murkiness, a lot of we don't know where things are going. If we can just become a little more clear, and people don't got to be like experts on knowing exactly where the economy is going and their business is going, but we just need a little more clarity. If we can get a little more clarity this earnings season than last earnings season, it wouldn't be surprised if the market kind of trends up over this next few months. If we don't, and people are still just as scared, then, ultimately we'll kind of just remain in this like neutral phase of like, well, we don't really know if we're going to move up or down or anything like that. Okay. And so that's just kind of what's going on there. Now, I suggest to everybody out there, whatever you use to track stocks on whatever service, okay, add a possible buys list. It's just an easy way to keep track of what your buys are every quarter. So I update mine every single quarter. And so right now we're in the second quarter of the year, obviously. So I have my second quarter 2023 possible buys. I have 19 different stocks on there, right? Am I going to buy 19 stocks during the quarter? More than likely, no. I might only buy, 3 or 5 of those 19 stocks. And there might even be a stock that comes up here or there that I add to that list or delete from that list over time. But it's just an easy way of keeping track of an actual list of stocks you're thinking about buying in the next quarter. Very, very easy. TSMC, semiconductor giant. Here's the deal with TSMC, okay? This stock is going to tell you everything you could ever want to know, okay? And the reason being is TSMC, they manufacture almost all the semiconductors you could possibly imagine. And so that's one of those companies that they're basically going to tell you how the tech industry is doing, how smartphone sales are doing, how computer chip sales are doing, right? Because they're the backbone of everything. Literally, they're the backbone of computers. They're the backbone of smartphones. They're the backbone of everything, okay? TSMC is. And so I think that's just one of the most important companies to really tell you how tech in general is doing, hardware, okay? And so definitely, I think it's always one to keep an eye on. I think the valuation is intriguing in TSMC, for anybody that's a long-term investor out there as well, okay? American Express, definitely one to keep an eye on. Charge-offs as well, especially in regards to that, right? Union Pacific. So Union Pacific, I've actually considered maybe buying that over the next few months, but the problem is I think they're going to have a lot of regulation coming. And also, if there's a slowdown in housing and just the overall economy, that's going to continue to kind of weigh on Union Pacific, but that's more of a short-term thing. I'm more scared about the regulation part because that's a long-term cost. The economy goes up, the economy goes down. It is what it is, okay? Like, you're going to have some economies that are great. You're going to have some, time periods when the economy is bad. But at the end of the day, regulation, that can hurt a company like a Union Pacific for a decade, 2 decades, right? If they have an additional huge cost. The Blackstone Group, this is one that is a lot of kind of like secret stuff being talked about of potential problems at Blackstone Group. So we'll see, okay? I think that's one just to keep an eye on.